Actually, I can tell you the sort of mindset I'm in. It's always looking for opportunities, never liabilities. And a great example of that is when Trump tweeted about his meme coin. I was quite literally watching it go up 1,000% with one of my friends on Discord. We couldn't get in. The Solana chain was down. I was fuming. I was so angry because it would have made me a multi-millionaire. I'm not even joking. But I missed it. And then anyway, I ended up getting in a little bit late, lost about $200, nothing big. But I would rather have a little bit of an attempt on a meme coin by the president than buy a car. Because I just don't need a car. I Uber everywhere. Oh, Alan. Yeah, same thing then. I think America's slightly different because America, I feel sure you need to have a car there because the roads are so wide and everything's so far apart. But the UK, it's easy to get around here. Yes, I was Royal. I saw you liking the post and I was like, oh, who's this guy? Small world. Euro dollar. I'm bearish euro dollar. I just don't see anything that great for the euro. I think the dollar is struggling as well from a data side of things. I wouldn't, and this is annoying. Well, not annoying. That's not the right word. I'm conflicted because I am very bearish on euro dollar. Because if we're going to break it down, I just need to be very cautious of time. Okay, Chris is here, so I'm just going to very quickly cover euro dollar before I go. So euro dollar, in my view, the euro was supported heavily by two things. It was the dollar outflow and it was the German stimulus. The German stimulus is priced in. That's not really a factor anymore. There's been no developments. It's done. The dollar was significantly losing value due to trade. Due to tariffs. There was a lot of speculation and fear around that. We're seeing that sort of cool down. But the price isn't reflecting it. I think we still have a lot of correction room down here on euro dollar. Definitely not looking for parity. I just think we can come lower. Anyway, guys, have a great one. Chris Pulver is here to take over the show. I apologize we didn't get around to many charts, but it is what it is. Have a good weekend, guys. Enjoy your Friday. Stay safe, and we'll speak probably not next week, week after. See you later.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
Well, what's happening, everybody? How we doing today? I am looking at a potential broken wing butterfly this morning. Just got out of the trade. I had two winners on SPX this morning. Watching to see if we're going to have some flows. I was looking at some unusual whales, 590, 595, 600 on the SPY today. That's a lot of direction. We do have I think it's a triple witching OPEX cycle, which means we have expirations today on stocks, ETFs, indexes, futures. Next week on Wednesday, we have a volatility. This is the VIX expiration. So, I mean, I looked at MAG7 this morning. There's some gamma levels that are interesting to the upside, but it's a little bit overstretched. I mean, Apple's expected to move about $1.50 today, and the move I'm watching is like a $5 gamma level. So I don't think we're going to get that much volatility today. Anything could happen, but I was curious, like, well, if we're not really going to go down, then maybe position myself for a little broken wing butterfly that has a profit trap today. That trade might work out for another 45 bucks. Let's see here. I'll move this a little higher on the chain, 65 cents. 58.95 is where on the price today. 58.95 is down below yesterday's low. I don't know. We're also trading in a pretty low volatility environment. I don't need to force a trade. I mean, I've had some decent winners this week. All in all, trying to think here. 12th was this week. Yeah, I mean, net pretty good. I'm closing up a winner today on Shopify for 106%. Got a bunch of covered calls are getting called away. GLD, Max Profit, DraftKings had a winner. Johnson & Johnson having a winner. Dow, let me check the old Dow. I had some naked puts this week. Had some 111s. IWM, fine. Where's my DIA at? There we go. So naked puts now trading for about 86% profit. I'm just going to let this one hang out over the weekend. I mean, if this comes in with 90+% on Monday, I'll just take the profit. 345 max credit, almost up to $300. Could I wait an extra 45 days? Of course I could. I don't really want to. So most likely, if this one crosses over $300 by end of today or going into Monday when we open, then I will close these up. Same thing here, up about 80%, $200 max. If I get this to 175 or 180, look to close out majority of the profit. Same thing here, same thing here. So those are looking pretty good. Those are out to June, but I'm going to close those up a little bit sooner. Let's see, AT&T closed out some puts this week. CB, this is going to be a full winner. This is a ratio spread. So up about $600. That'll close out by end of day today. NVIDIA naked puts, I close those out this week for profit. Collar trades running out to July. That's fine. Naked puts, it's up 70%, pulled in 350. Same thing here. This one, if this gets up to like 75 or 80% max credit, start pushing up near $300. I don't really want to hold this for a full cycle out to December. So it's looking better. I'll just let time do its thing. UNH took the brave move on UNH. This one, I can't believe this hasn't closed yet. I literally have a credit sitting at $1.99. It won't fill. It's going to max out at $2 today or settle over the weekend. There's just no bid ask prices where I'm trying to close it. I was working on a transfer yesterday for one of my clients, and I had to close up a collar trade on silver. And I mean, it's 100% profit on the collar trade because it's, the put's worthless, but the covered call is full credit, and I couldn't even get it to close. So I called the Tasty Trade desk and I was like, just let it close on the weekend, let it expire, and then I'll do this transfer on Monday. So some of the bid ask prices are a little bit zeroed out based on some of the strikes I've already put in. I want to take a look at AT&T. All my naked put combos are looking okay. Again, pulled in $6, up about 60% of that. 25, 22, and 20. Trading up to 27 on AT&T. I think I like buying the dips on that. I think the structure of that chart looks pretty decent. To me, that was a value play from the teens. So we came down to like $16, $17 in AT&T. I've been buying it since that level. Still participating in the low 20s, but there's decent amount of premium I'm collecting on that one. UNH. So I took the ratio spreads. And already, so I pulled in a ratio spread for $424 credit. It's already up $200. Like literally, I took this trade yesterday. This trade's already up 50% in a day. That's not too bad. I mean, that's not too bad. So here's what I'm going to do on UNH. I think I'm going to sit on the weekend, like let this work over the weekend, get that extra Saturday, Sunday time decay, come into this trade on Monday, and see if this is up towards like 55 or 60% and just take the profit. Ideally, I mean, pulling in 424, if I were able to close this thing out for, $300 or $400, that'd be pretty nice. But I also have the 260 by 270 ratio spreads, which are still down quite a bit. That was, that's a nasty spill, obviously, with like that much. That it's a naked put. So I mean, the 260 is technically a cash secured put that I would be taking assignment on, but the stocks or the expiration is also out to January. So there's still lots of time in the trade. Question comes in. I've been searching your channel for a while for a good video on dollar cost strategy. I mean, I can do one on dollar cost averaging. I'll throw one on my video. I'll write that down. Dollar cost averaging. I'll just throw it on my YouTube channel. Okay. Now tell me this, dollar cost averaging into what asset? Because it's not always going to work. I mean, assets that are tending to go higher. I'll give you an example where it works really well, an example where it works like garbage. Here's an example where it's been a struggle bus, but you gotta ride through this stuff. Like here's Meta. Okay, if you dollar cost average in Meta from let's say 2018, I'm just picking a number here. You dollar cost average. Okay, I mean, in my opinion, a dollar cost average in a stock would be 10, 20, 30, 40, 50%. If those are your pullback levels, you have, let's just use a simple example. I'm going to say, okay, I'm going to invest 10K in this stock. We'll just use a stock, right? So 10% pullback, 20% pullback, 30% pullback, 40% pullback, and 50% pullback. Now, again, you'd have to have the case. Oh, you're talking Forex? All right. Well, I'll do a quick stock example, then we'll go Forex. If this was a stock and you believe like this stock is going to go higher, I like this stock, I want it to go higher, then a 10 to 50% allocation, you take your $10,000 or whatever number you want and then splice it up. So this would be 1, 2, 3, 4, 5 installments. So that'll be a 2K installment on each one, right? So you put in 2K, another 2K, another 2K, another 2K, another 2K. Now, if you don't get the pullbacks, you don't get the 30, 40, 50% pullback, that's okay. You can just keep the, $4,000 invested, keep the 6 on the sidelines. And if price goes higher, that's okay. And when you are, this $4,000 is up a certain amount, you can peel that profit back to 4K, still allocate, look for the same thing, like kind of reset your numbers at, all right, if from this high, we get a 10, 20, 30, 40, 50%, I'll still kind of keep the same game going with the allocation. Bigger picture is you're trying to invest in something that's going to keep making highs. That would be the stock market. Forex market is a little bit different. Okay, Forex market, I'll give you lots of examples, dollar cost averaging, because I've been doing it a lot in the Swiss crosses. So here's the dollar cost average on a Swiss pair, right? So right now, actually, you know what? Let me go Aussie New Zealand. This one may be a little bit simpler. So Aussie New Zealand, if I were to dollar cost average, let me go to the bigger time frame, and this is what I'm doing. I'm using typically larger time frame support resistance levels to dollar cost average into. I'm not talking like dollar cost average into short term. I think that gets you into too much trouble if you get on the wrong side of a bigger move. So if we look at the bigger picture here on the daily or weekly chart, we've got these major lows back in 2018. We have this major low back in 2015. So, I would be willing to invest in the Aussie New Zealand and say if we hit 106 and we hit 103 and we hit 101, I buy, I buy, I buy. Price levels for profit would be anywhere in here, right? So profit target, and 106 to let's say 112, 103 to 112, 101 to 112, monster profits, like monster pips. Could it take time for those trades? Of course. When it bounced up here, it took months, but they all paid. Make sense? And the same thing is true on resistance. I mean, if you thought, well, it can't go much higher than this level or this level or this level, then you can sell here, you can sell here, you can sell here. You still want to have a plan, I mean, I don't want to sit here and like, if this breaks above 116 and wants to go to 120, it's like, I don't want to ride that to the downside. I don't want to be stuck in the wrong side of the trade. So you still have an exit plan. But the bigger picture of me and as a Forex trader is if we have strong support resistance, I like to buy supports. And even if this is a, trade 1, trade 2, trade 3, if trade 1 is a losing position, but trade 2 and trade 3 can get me back to break even, you can take the winner here, take the winner here, take a small loss or a break even, close the break even, take a winner. You survive the trade, you let price do its thing, you trade the efficiencies, you trade the equilibriums, you trade the reversions, you give yourself a lot more time. Make sense? So in order to dollar cost average, you do have to trade, in my opinion, you have to trade really small. I trade very small in the Forex market. If I have, a lot of my master accounts over the years when I did Forex was either a 50K account or a 100K account. And then I had a client's accounts that were linked to that, and they would just copy the trades. So that master account was just easy numbers for me to do the math on. So like 100K. I rarely used margin with my Forex accounts. Even though I'm a US trader, I have 50-1 leverage. I rarely use leverage. I rarely use like more than, I'd say, 70% of my margin. So, I mean, if I had a $100,000 account, I would trade literally micros and minis until they built themselves up to multiple mini lots or multiple standard lots. It was rare for me on the 100K account to have one position on a currency pair that would get more than like 1 or 2 standard lots. But if I build that position up, let's just use this as an example. Okay, if I did a dollar here, dollar here, dollar here, just so it's going to be like 0.14 mini lots, and it ends up being $1 a pip roughly. So I could take about a $600 drawdown here, okay, about a $300 drawdown here, and maybe a $50 to $100 drawdown here. So for about $1,000 risk, I could play big areas. And for $1,000 risk, I mean, I'm putting a 1% risk on the table with the probability this market doesn't necessarily go below my level. So I don't have to really risk more than 1% in the trade. But when I take trade 1, 2, and 3, okay, so I'm in to each one of these trades. If this trade pays me, this one gets me back to break even. What's my payout? And on top of that, if I find a bottoming pattern, I can also still add, positive trades to a price pattern that I think, okay, we got a bottom. I'm going to start adding to this winning trade. I do have a video on that. I talk about, adding to winning trades. That's in one of my Keep It Seriously Simple videos. But I'll just do the dollar cost averaging here. If I did trade 1, 2, and 3, and trades 2 and 3 paid me, what would that profit target be? Well, that one would be up about $300, and that one would be up around $540. So we're looking at a net around $900. Okay, $900, and I don't even have to win all 3 trades. I could take this one like break even, winner, winner, and I make $900. My max risk was about $1,000. So, I give the market time. I give price plenty of room to breathe. I'm not getting stopped out and wicked out at all these crazy turning points, and I can still make some money in the trade. I'm only adding to those key levels. I'm not adding anything to my winning side, which would really be the critical spot to making this a very profitable type strategy. Is when you find a strong bottom, I like to also add buy stop levels in that direction. So I have trade 1, 2, and 3, but if we bounce here, I want to be adding back up into level 1. So I can still take level 1 as a break even, but if I added in 1, 2, 3 more trades, those can pull out little winners. Maybe I can edge this out to, $1,100 profit or $1,200 profit. And then I can actually make more than what I was initially risking on the dollar cost averaging. Make sense? So summary is this. If I'm dollar cost averaging, which I do a lot, it's higher time frames, it's key support resistance levels, and it's trading very, very, very small. It's not complicated. It's also not super exciting. It takes me sometimes months to get profits, but if you ever look at my January to December performance, it usually looks something like this. From January to December, it would be, let's say, I'll just type this out here. So if we have January, whatever, I don't know. You get it. There's going to be like some histograms here. It would be, a little tiny month performance, maybe a little tiny drawdown for a month, and then a big chunk of profit, right? And then another little performance here, and then another chunk of profit. So it would be in a course of 12 months, I'd have like 3 or 4 months that would pay me like 8 to 10% of my account. And then the others were just like little ups and downs of ones and twos. But my chunks were always, 6, 8, 10%. And so I might burst up to, 25, 30% for the year, give back a couple, on some drawdowns, carry some drawdowns in some of the positions I'm in. But, net on the year would be around, 20, 25%. And it wasn't terribly complicated. I didn't have to use a lot of leverage. I didn't have to stress about the, intraday swings. I didn't have to stress about the noise in the market. But it's patience. I mean, and a lot of you know this, but my initial starts in the Forex market was scalping as a day trader on a 1-minute time frame. Like I was in the trenches every single day, grinding out 20 pips a day, and it was just so much more stressful. That's not my personality. I'm way more just I want to be even keeled. I don't want to be emotional when I'm trading. I hated like when I could feel my heart literally beating in my chest. I thought that was way too much like adrenaline for a trading. For trading, it's like it's not how I want to trade every day. So long story short is I went to bigger time frames. I took on a lot of the time stress, and I just kind of patiently let trades come to me, find big levels, and those big profit chunks pay out. So it might take months for a trade to come to fruition. It might take months to get the profits that you want, but over the course of the year, if I could still net 20, 25, 30% for my accounts, I was doing really well, and I wasn't using a lot of risk. So, my risk adjusted returns were pretty solid. I had drawdowns that were pretty manageable, and gains that were almost double that or better. That makes sense. Would you say it's your go-to for forex? I mean, this is definitely how I trade. Like this to me is my preferred way of trading. Like this is how I survived the forex market, running a currency fund for over a decade, and did really well. And I survived, the 2012 yen. I survived the 2014 dollar. I survived the Swiss National Bank crash in 2015, Brexit in 2016. We had a vol event in 2018 and flash crashes in 2018, COVID in 2020. When I really started to move away from Forex, this is no joke, like 2022 was the year that made me the most angry because everything changed with interest rates. And I was watching good positions get punished by negative swap, even though it was a positive swap environment, but it hadn't been passed on to us as traders. And I mean, I'm managing a fund, man. I mean, so I'm like positioning into Swiss pairs and trying to exploit this like 4% rate differential. And I'm getting charged every day to do it. And I was furious. And in 2022, it's like that was a bear market year for the markets. I did actually, net out some profits in currencies, and it's what saved my portfolio. I mean, I ended up making money in 2022 because of currencies, but I was so angry at like every single day my broker is charging me, between all of my accounts, I was probably losing, I don't know, hundreds of dollars a day holding positions that should have been a positive 4 to 5% swap. Like, and I held it for months. I was holding trades for 5 or 6 months, and then of course, like January 2023, it turns and I start noticing positive swap, and I'm like, I just felt like I was getting robbed for 6 or 7 months from negative swap. So I just thought, like, F it. I'm just gonna migrate into options. I trade Wimmer options. I'm just my risk is better. I don't have any swaps. I just pay a one-time commission, and options are just much cleaner. So I still like Forex, and because we've got positive swap now in the Forex market since 2023, I've been hanging on to Swiss crosses since then, and I'm dollar cost averaging those Swiss pairs. They'll pay me. The Swiss pairs will pay, and I'll honestly, the nice thing is since I've been holding it for so long, I'm probably going to double my account, and it's not going to be, oh wow, I doubled my account this year. It's like, look, I've been in these positions since 2023. So if I double my account, it's going to work out to be somewhere between 25, 30% annualized over a 3-year window or so. That's still pretty good, right? For something that's like I spot check a couple times a week and just make sure nothing crazy's happening, right? So yeah, but it's I don't know if it fits everyone's style. I've had a lot of traders follow me over the years. If you are a bigger picture trader, if you're a position trader, it's a little bit easier. I think it's a little bit easier. You can let great trades come to you, and I would say in a given year, I mean, I find, let's say, a dozen great trades. When I identify a great trade, to me, it's like I'm going to put in 10, 15, 20 positions to build this trade from start to finish. And when those trades are done, that's usually what this profit chunk looks like. That's where I can turn, 7, 8, 10% gains in my entire account on one position because I build it, right? But I start it with like little tiny building blocks. It's tiny, tiny, tiny. And I will literally take like 50-cent pips, 50-cent pips, 50-cent pips, dollar pips, and average it into, maybe adding up to eventually like a $5 or $10 position. And I'll still add to it until I get to my profit targets. And, I've got exact levels I want to see price go to. I have, good enough levels that I'll take profit at. But I do a lot of symmetry measuring in the markets. I do a lot of pattern trading in the markets. So when I see a good price pattern, I tend to, watch it, measure it, look at my waves, and have the patience to hold it. Can you trade options on a simulated account? There are a couple brokers that, yes, you can do that. I know that Thinkorswim's platform, if you have like a Schwab account or a Thinkorswim account with TD Ameritrade, which is now owned by Schwab, their platform allows you to have like a 100K paper account. You can trade options with them. Yep. I think there's some other ones that have. I think E-Trade might have a demo account as well. Webull, I think, has paper trading. But yeah, you can trade options on those. Okay, does that make sense? So little rabbit hole there for Reverie, but hopefully that makes sense. Okay, top down today. Markets are flat. I mean, this is intraday price action on the SPX. Boring, but good for me. Took 2 winners this morning out of SPX. I'm trying to eyeball maybe another directional trade for the morning, but I think I'm okay. You know, like I said, I've got trades are closing up. I'll sit over the weekend, double check a couple of things. We should have decent chunk of profits. I mean, I've got lots of income trades this week on some cover calls that I rolled. Took a winner on HIMS on a diagonal spread. Took a winner on a ratio spread, AMD. Rolled calls on IWM. Rolled calls on Tesla. Rolled calls on MicroStrategy. Cover calls that I'll be adding to it. IBIT, Snapchat, Pfizer, Silver, which SLV, Baidu, JD. Win on AT&T. I'll look at the Dow next week. Johnson & Johnson was a winner. I want to take a look at UNH. That ratio spread I put into the Pulver alerts is already paid 50%. Over the weekend, if it's up like 55 or 60%, then I will probably just take that trade off. But also probability with the IV changing so much. I mean, this yesterday, I don't know if you saw this with me yesterday, but this IV rank was a 150 yesterday. Like insane. Also, if you look at the, let me just go to a simple like overbought or sold condition here. Let's go to this chart is a little messy, so bear with me here. But I looked at this yesterday during my YouTube session. Check this out. This bottom chart on the daily time frame. This is the daily relative strength. I've been trading for a long time. I don't think I've ever seen a relative strength index get down to 12. I mean, we're talking like 80-20 is like, oh wow, it's way overbought, it's way oversold. I've seen the oversold condition. I think it was on, oh fudge, what chart was it last year? Was it Palantir? Something was like in the 90s for overbought conditions. Like the relative strength was so pinned to the top, it was like 90. Maybe it was Nvidia. It could have been Nvidia. Anyway, it was just a sign of like, yeah, this thing's overbought, you know. Anyway, but we're down here at like 12. So I mean, look at this. This goes back to 2014. I go back to weekly time frames. Like we're not going to see this on any time frame. You look at the weekly chart. Weekly chart here. The value is like 20, but it's way back here in like 05. So I mean, obviously that's a pretty rough patch from like 2000 to 2008. Weekly chart is still oversold, but the daily chart, good Lord, daily chart, like one of the most extreme things I've seen in a long time. So that is why I decided, look, Ivy ranks at 155. It's just a trade. I know it's a ratio spread if you're not comfortable with the kind of cash secured put, but the probability is that expected move is going to be way more than the actual move, which is what I try to take advantage of when I'm selling options. So far, so good, right? I mean, because of that, right here, I mean, that ratio spread is already up, 40%. Now, a little bit more time. I mean, this is out to July. It's only out 63 days, which is a lot of premium to pull in for a 60-day trade. But I also think that the expected move, I mean, with this Ivy rank already down to 108, if this thing gets back to 100, 95, 90, the IV just kind of contracts and reverts, then this most likely will be a very easy winner. So I will probably protect this thing around, I'd say $350 to $375, and just take the profit and do it well before expiration if it's offered that way. But it's not every day you find a trade that's just that ridiculous. I had a question pop up like, what's your favorite stock? I'm like, honestly, it's not my favorite stock, but it's my favorite trade right now because it's just such a good opportunity to see that the expected move and the implied volatility move is so much greater than most likely the actual is going to be. So pretty wild stuff on UNH. But anyway, like I said, that chart's messy. All right, let's keep going. Let's take a look at the heat map this morning. I want to look at some levels. We are pushing a little bit lower on SPX. We did break the morning range here. So it's fine. I mean, I think that this market is still very much due for just a pullback. Just a pullback would be great. Does it pull back into this area? This 5,800. Do we actually come back and try to fill this gap at all? Fine. I do have a 590 by 580 bear put spread on the SPY. So if we pull back into 580, I'm looking to grab some profit there. It's not bearish. Like I'm not bearish on the market. All I'm looking for is just give me something to buy a dip on, would you? So I'd love to see a little bit of a pullback. Even this area it's very shallow, but maybe this market is just like that's all you're going to get is that little 2 to 3% dip, and this market just melts up until we get to highs. Data is showing resiliency. I'm flabbergasted by how quickly the sentiment has shifted. I saw Nick post this morning, but we've got the put to call ratio. It's like we're getting into extreme greed territory now. The CNN fear and greed is showing the same thing. I mean, we've went from this was down to like 20 or less. This was like a 20 when we had March and April sell-offs. Like this was extreme fear, and here was just like, nope, it's greed again. But market momentum. I don't think this is accurate because we're above this, but we had such a big recovery to get back above the 200 moving average, and our moving averages haven't quite crossed over yet, like the 50 and the 200 or the 100, the 200. They're not all pointed up yet, but stock price strength back into greed territory, breadth, extreme greed territory. Here's your put and call options, greed territory. So that's what you're seeing here in the Edge Finder, right? I mean, if I could go back further on this, I'm curious if I can go back. I want to see if we can go back like a couple of years, but you don't get a lot of these big swings in such a short amount of time. That is a big fear swing, and this is a big greed swing. And look, I think naturally the market overshoots either direction. It overshoots on the fear side, it overshoots on the greed side, and reality is going to be in there somewhere in the middle. So I wonder, like, if the market doesn't quite have what it takes to get to all-time highs, do we have just a little bit of settling? Do we settle back into here for just some, pausing? Is this market just destined for just crazy amounts of direction? I did think about this a lot this week. I don't know if we expressed it like explicitly on these sessions, but I think we could be going into like another global bubble situation, because now that the US is at least shown some very quick resiliency, the Eurozone is still performing well. And they're not like, nobody is flawless here. Nobody's flawless, but the US is showing resiliency. The Eurozone, Asia, mainly China, Latin America, emerging markets, they've all been performing pretty well and outperforming the US this year. Okay. As long as the US remains resilient, I think other countries and non-US performance will be good. So, easy way to watch that. I'm trading this. This is SCHY, which is an international dividend ETF. There's also international growth, right? But I have this stock it's an ETF that I bought down here around like 23.50, so near the lows, and we're back up towards the highs. This is mostly Europe and US based, and then my ILF and EWZ for Brazil. I've been waiting on these in a multi-year kind of downtrend. I was going to buy more around 18 if we hit ILF at 18. We didn't. Brazil was a little bit closer, so EWZ a little bit closer to like the COVID levels. Okay, so I took some stabs in the low 20s. Now, like I said, non-US could perform very, very well. You could look at the MCSI. So here is MCSI X the US. Okay, look at this thing. This thing is at fresh highs. Okay, so that recovery has been way more robust. That is up around 20%. And if the world is going to outperform the US, then you can take advantage of it a lot of different ways. Now, I don't know how sustainable it is. I think that if something were to happen where the US is troubled, it's going to weigh on the world in a big way. So, long story short is, if this is Trump and company are pivoting now to like more fiscal expansion, we want to pass this big tax bill in July, and what comes into that, I actually found a little snippet, which I think would be interesting. I wish people would care enough to do the research, But here's what's happening with a bit of the highlights in the tax bill. There are tax cuts, okay, but there's a huge change in Medicaid, which is basically like your Affordable Care Act that gives everyone a chance to have some health insurance. What is the reality of this? And this happened under the Obama administration. But if you are barely working, if you're not working, if you're unemployed, but you still have government assisted health care, they're going to kind of phase you out. So you have to show, like, I mean, just the harassment of, like, you have to show you're at least working at least 80 hours a month, or the amount of paperwork that's going to go into like maintaining coverage for you or your family is going to be a lot harder. It's going to be difficult for, lower earners or lower income brackets to maintain coverage, and they're going to be pooled into everybody else that is insured. And guess what it's going to do to healthcare costs? Drive them higher. Okay. Immigration. This was interesting. The bill would increase funding to help build a wall for the U.S.-Mexico border. Wasn't that Trump's big plan in 2016's campaign? We're going to build a wall. How well did that go? We're doing this again. We're putting this in a freaking tax bill. So here we go, round 2. We're going to build a wall. Cool. Clean energy. We're essentially doing it with clean energy and deregulating. And then more MAGA savings. We're going to give a $1,000 tax credit and the ability to contribute for tax-free until your child's 31. Well, most likely lower income families won't be contributing anything. They'll just take the $1,000 tax credit, hoping that they can get more money per kid. But it's what I'm saying is, like, all the crap that is putting these bills to get passed. It's ultimately going to be the same thing we've always seen in the U.S. in the last 25 years, which is the haves benefit, the haves not. I mean, yeah, maybe there's a bit of assistance there, but it's like, it's just going to make stuff more expensive. And I just don't know how this ends. I don't think that I think the plan to roll out this global trade war was good in theory on the the sounds and the marketing bites of, we're going to cut government spending, we're going to balance the budget, we're going to decrease the deficits. All that sounds great, but April showed us how difficult it really is. And I don't think it's going to go back to that at all. I think Doge is over and done with. I think this whole idea of trying to drain the swamp and cut government spending and cut the fluff and corruption doesn't exist. This is what broke the market. When this pivoted hard, and basically look at your bonds right now. I mean, the U.S. is continuing to see a multi-year drawdown in the bond market, and I think less and less and less bond buyers are going to be like lining up to buy our debt. I think the U.S. Treasury might have to get pretty creative here. We might have to start issuing different durations. Most of the government has been surviving on short-term duration bond yields. So what we're doing is we're offering auctions at like two year. So it's very short term. And I don't know what happens. Like, the Fed could very well cut rates this year. Okay. And we, as I mean, let's say U.S. consumers here, we might not see the benefits of any of it. Okay. If the U.S. cuts this year, so here's probabilities. They paused. They're looking like there's a higher probability pause again for July. So now the first rate cut probability is in September. Okay. I mean, I'm fine with Jerome Powell, like, sticking to his guns, not cutting rates early, not trying to cut rates because they potentially stoke inflation. Look, inflation will be the killer here. Like, Jerome Powell's legacy, if he ultimately does find a way to tame inflation, even if they adjust the inflation target from 2 to 3%, right? Like, we've had 2% for all these years. If they adjust it to say, look, we have realistically been running around a 3% inflation level, and we're willing to accept that with our economy, like, they can adjust it. It doesn't have to be this, 2%. Like, maybe it's impossible to get there, but 3% is more realistic. That's about where we are. We had headline inflation at 2.3. But my point is, I hope that Jerome Powell doesn't bow to, like, stupid pressures and tweets and whatever about, X, Mr. Late, Mr. Loser, whatever. It's like, shut up, dude. Just let the Fed do its thing. They're not here to proactively do anything. The Fed is here to reactively backstop and save things if they have to step in. And it's manipulated, and everybody knows that. But you're glad you have the Fed. 2023 with the regional bank crisis, Fed saved it. 2022, after we got into the little bit deleveraging, Fed saved it. COVID, Fed saved it. 2018, Fed saved it. 2000, like, all these years we've had nasty pullbacks, Fed saved it. So that's where this whole Fed put's been in place, right? My point is, if the Fed cuts rates, Okay. Does it actually change anything in the housing market for US buyers? Maybe not. Does it change anything for buying a car? Maybe not. Financing on like 5, 10, 15, 20-year terms may not change at all. Businesses trying to refi for 5 years, 10 years, it might be at double, triple the price of what they took out loans in 2020. You know, billions and I mean, who knows, trillions of dollars taken out during COVID in loans that'll never be paid back, but they could be refinanced, but they're going to be refinanced at multiples higher. So I don't know if even cutting rates from the Fed this year is going to be beneficial to the average business or the average borrower. I have a feeling like we might not see any of the benefits from it. So it's going to be weird how the lifeline is way more expensive and how that doesn't hurt growth going forward. Not to the point of stagflation necessarily, but to the point of, holy crap, the US is slowing down. These valuations are excessively high, and I don't know how much longer we can run at these high valuations. So big picture, I think it all shakes out eventually. But if the government's going to spend money and the Fed is maintaining stability and the Eurozone is going to spend money and China is going to spend money and all these countries are willing to add fiscal policy, add fiscal spending, like the US has done for all these years operating with these deficits, a global bubble could certainly exist. So as rational as we want to be about like, it's unaffordable. These valuations are crazy. You can't have these high prices. If everybody is spending and money supply is increasing, stocks will go up and probably go up by a lot. So go back to, an index. It is very possible that, as much as I want to be rational and say like, yeah, we can't go to all-time highs without having some type of pullback. Look, we can go here and we can break and pause and we can go up again and we go up again and we go up again. And this is just the dumbest correction that the market's had since COVID. Okay. And then here we are at all-time highs going into another giant bubble. That could happen. So, my bearishness is like, I know how irrational this market can get. I know how hot this market can run. We've seen it over and over again. So don't fight this momentum. I mean, I'm just asking for a pullback so I can participate in something that looks a little bit more reasonable as opposed to it just goes up. It just goes up. So anyway, that's the point. The market can run hot. I've projected, on SPX here, I think I projected I'm trying to think what workspace it was, maybe a blank workspace here. SPX. Yeah, here we go. So let's just take a quick peek here. Let's say, and I'll just make this a larger pattern. Okay, so bear with me on the drawings here, but let's say that this is a high, and we're going to form let's say we form a high in the interim, like the next maybe 2 weeks, and the market pulls back a little bit. Okay, well, this could be setting up for a larger bullish pattern. Okay, if we get a pullback here, this is still a very well supported market by the bulls, and let's measure that move. So what I'm going to do is this. I'm going to take my low to high swing, and this isn't perfect yet because I don't know if this is going to be the top, but let's say that's my low to high swing. I'm going to project, let's say we have a pullback towards this blue line or this blue line. Okay. Oops. So conservatively, let's say we pull back to like 57.50. So I'll have a projection here, right? I'm going to put a projection line in green. So we'll go green there. And if we have a deeper pullback, maybe green here. Okay. That still gets us to all-time highs this year with some room to run. We could get 66, we could get 68. Not a bad spot. Now, what happens if this ultimately is a run up into the highs and this becomes the top, and then the market pulls back for a deeper right shoulder in here? Well, then we have this swing, right? And we have this pullback. Well, I'm going to make this a little bit larger. Let's take this area, go up, and then we project the same thing. We pull back into this level as kind of a deeper pullback that still gets me to the same level. Interesting. Okay. Or we have like a shallower pullback into here, maybe a little bit higher. So it's not perfect, but I would say that I wouldn't be terribly surprised to see this market have its destination set on like a 6,600, 6,800, even 7,000 plus target. And how am I seeing that pattern? It's going to be some type of like crown pattern or some type of head and shoulders pattern. So right now, this would be a crown structure because we've broken this recent high. A head and shoulders would be, we'd have to come all the way back up here. Head and shoulders this is your like head and shoulders. So here's your neckline all the way at the highs at 61.73. If we break that, I mean, measure symmetry, measure the projected move, right? And that's just on symmetry. If I want to go one step further, let's say this is a swing back to the highs. If this is a head and shoulders trade, then you measure it out here. And this thing's, we're talking, 75. Now, that's likely not going to be hit this year, but 7,500 is reasonable to think in the next couple of years if we just continue to push through these pattern measurements. So just saying, like, don't fight what is potentially global fiscal spending. It's not just the US doing it anymore. I mean, you have to remember, post-COVID, how'd the markets go up post-COVID? The US. That's how the US was labeled with American exceptionalism. That's how the US was performing so well, because we were just operating at a massive deficit every single year. The Biden administration was extremely favorable for global flows and anyone that's been investing. Like 401ks did extremely well. Pensions did extremely well. Anybody in the markets did extremely well. We had very few hiccups from 2020 outside of COVID, which wasn't Biden. It was like Trump was done as president 2020. Biden takes over, right? Again, and he's a puppet. Like Biden was an 80-year-old with dementia, and he's our president. So I'm not giving Biden credit. I'm saying, like, as an administration, it was spend, 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 deficit, 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 Fed. We had a deleveraging in 2022. The market had a 25 to 35% deleveraging event. That was it. We got out of it from how? Fiscal spending. What were the last couple of years? Everyone's calling for a bear market. Why? Because, well, the Fed's been tightening. Well, the government's been spending a crap ton of money. So now if you have the world that is now joining the same thing, Euro spending money, right? Eurozone spending money. US is going to spend money again. China is spending money finally after 4 years of lockdown. Global money supply, global liquidity. That's where the next asset bubble is. So all of us know here that these markets can run hot, and the famous saying from John Maynard Keynes is markets can remain irrational longer than traders can remain solvent. The nice thing is when the market remains irrational to the upside, just don't be an idiot and try to call the top, and you can make a lot of money, okay? All I'm asking for is the market to pull back. That is all I'm asking for. Give me a pullback, please. This would be great. This would be outstanding. Even if we pull back into here, I would still think this market is postured for bullishness, and I will take my stabs. Okay? So a pullback, I'll nibble. A pullback, I'll nibble. A pullback, I'll nibble. I will probably be selling premium. And if I'm going to take assignment on any shares, I'd be doing it way below the lows. But if I can nibble here for all-time highs, all-time highs, all-time highs, those are great income trades for now. And that's my next plan is give me something on S&P, give me something on Nasdaq. Dow is fine, but UNH sucks so hard that UNH has been dragging the Dow down. Russell, I don't love the Russell because I know that most of the companies don't make money. I like the Russell because it's not so aggressive with the market cap weighting like the SPY and the Qs. And so that's why I opted to buy it. It's cheaper. So I'm buying shares of the Russell so I can sell premium against it. And I'm just using it as an income vehicle. But if I'm looking to own shares, it's like I want to own SPY at a discount. I want to own Qs at a discount. I can own those. That's why for this entire move here, all I spent time doing was selling premium, collecting income, and with the cash that I've raised, I want to deploy that. I want to be a bigger picture investor. I think this market can go higher. I'm just asking for a pullback. Why am I so political? I'm not political. Nothing about what I'm doing is political. Okay. I am a centrist that hates politics, that wants to trade. But unfortunately, politics has seeped into the market so heavily that we have a politically driven market. Trump literally tweeted, it's a good time to buy. What president's ever done that? None. What president's on the economic calendar? None. So politics is now integrated. So look, I'm a centrist, man. I seriously hate politics. But you have to understand that this political scene is way more tied to what these markets can and can't do. So it's all blended together. So I am a technical trader that is fundamentally aware, and I think if you're ignoring that stuff, I mean, you're good. I mean, you can ignore a lot of the noise, but the bigger picture is I think this market can go into another bubble. And how do we do it? Because everybody's spending. If the US is going to pivot hard and spend, and Eurozone is spending and China is spending, that is fiscal policy. That's how these bubbles are created. And this is no different than what we've seen since 2018. It's ups and it's crashes, and it's ups and it's crashes. So, we call this a crash. I mean, technically it's going to be labeled as a correction because it hit 20% and then responded so reflexively that we're back up here and we've rallied 20+%. So it's a correction. But, all I'm saying is, look, I want to pull back. I want to nibble at some pullback levels. I hope we get it. I would actually be more angry if this market gets to all-time highs. But I'm just saying, like, this market might surprise all of us where it just doesn't pull back. I hate saying that, knowing like I don't want to participate in that. I don't want to participate in this market making all-time highs and thinking like that's how I have to make money. So what I'll probably do is sell a bunch of covered calls and just keep collecting income, and I'll be fine. I can still outperform the benchmark making covered call trades. If I don't like a trade, I'm not going to force positions. Right? So anyway, if you said, I just funny, why am I so, I'm not political at all, man. If you know me, I'm a centrist. I'm a trader, but unfortunately, this crap is so in your face every single day. Like I said, we've never had a president that's tweeting about buying the market. We've never had a president that is saying, that's on the calendar every single week for a press conference or something that's going to be related to the markets, the bond markets, the trade wars affecting the markets, right? So unfortunately, it's now like blended into fundamental analysis. So anyway, and it's annoying. Look, it's exhausting. This look, 4 months, 5 months into this Trump 2.0 is exhausting. I mean, I didn't forget this stuff. 2016 to 2020 was exhausting because I don't want to be political, but you have to at least understand what's going on a little bit, be a little bit aware. I'm just saying that what just happened is we pivoted hard. Like Trump and company were willing to break something. Well, they got their taste of it, and if they wanted to make it worse, it could have been a lot worse. But I think the break here is it's forcing other countries to consider their alliances to the U.S. And I think that the reality is the markets need the U.S. I think the U.S. resiliency and stability and liquidity is going to have to be is going to have to stay steady. But the flows going to non-U.S. I think are going to be as strong as ever before. Like if there's 1 year that the dollar is going to show that, hey, look, the dollar's fragile, this whole idea of like moving away from the dollar, it is 2025. Because of what just happened these last couple months. This is the closest thing I've seen in over 10 plus years of how this whole narrative of this death of the dollar. Well, this might be the time. This might be the biggest crack in the dollar since I've seen, since like the great financial crisis. So it could force the world to align away from the U.S. and align away from the dollar and just, at arm length, like, yeah, we'll do business with the dollar. We'll do business with the U.S. because we have to, but not because we want to. Like that might be how disruptive this whole thing's been. Okay. What says I can't. I mean, I guess it's a rant. It's not a rant. Like I'm not frustrated. I'm more annoyed of like what this market is. If this market gets all-time highs, I'm annoyed. But I say that and it's like, I'm at highs for the year. The nice thing is by the time we hit this level here, I was back above my portfolio highs for the year. And, that's well below the previous level. So, I mean, I'm still outperforming the markets pretty well. However, I'm doing it with more cash than I've had in years, like more cash to allocate, more money sitting on the sidelines. And I hate that. I want to invest. But I'm not just going to dump money into thinking like we're just going to, euphoria again. But it's kind of the probability of like, we probably will. We probably will go into euphoria. Why? Because sentiment, it's like the pendulum swing is so slow that we go from extreme fear to extreme greed. But what's funny is like greed tends to last a lot longer than extreme fear. And that's what I'm saying. Like that saying is so famous for a reason. And it's so true. This market might go up to levels that like nobody thought it could go up to, right? But in a given year, and this is what's so dumb about like basic Wall Street analysis. Every year the year starts, okay? The average plus or minus on the S&P is about 10%. Okay? So how does a forecast happen? Well, if we're coming into a bullish posture year, most Wall Street analysts are saying we're going to be up to about here by end of year. And they go, well, in respecting an anywhere between, if we average about 10% a year on the upside, the average drawdown is about 13% historically. So what do they look at? They look at those ranges. If we're up 10%, if we're down 13%, where are those levels from the beginning of the year? They map it out, and that's their forecast. And guess what? Forecasts are meaningless. They can change every single week, every single month, every single quarter. Nobody cares. They're all wrong. So what I'm trying to do is look at the charts. This in real time, we broke all the structure. We had that 200-day moving average. We had the rotation out of the MAG7. Was this not forecasted and telegraphed? I mean, I said for multiple months going into the end of the year, I'm bearish going into early 2025. I think we're going to have at least a pullback, 10%. Well, we got it. Okay. You throw Trump on top of that, he accelerated this to the downside, you get 20%. Okay. Well, fortunately, that previous high in 2021, 2022 acted as support, and we have not looked back since. All I'm saying is, give me a pullback. So, and I'll just ask you, look, we always have a nice crowd here with A1 Trading. Would you be more excited about a chance to buy a dip? Or would you be more excited about, like, I'm just going to buy the highs? I mean, obviously, I'd rather buy a dip and have a chance to participate with another run to the highs, as opposed to, you got to get in, it's going to go higher. Because if you look at this, it's like, where'd you trade it? You either had the courage to trade it in the peak of fear, or maybe in here. And now you're trading in like this low volume, no man's land drift where it's like the market just doesn't want to go down right now. So anyway, all right, I'll stop the rants. I'm going to keep this chart blank. I'm going to keep this workspace blank. I'm trying to work with a cleaner chart, but does everybody see what I'm talking about here? I mean, if we have a pullback, that's a good support level. That's a good support level. If we find a way up to all-time highs and it pulls back, I mean, fine. Just I'm hoping for a pullback. I know. And we are close. We're close to the all-time highs on everything. So SPX close to the all-time highs within about 4%. Yep. Nasdaq from the all-time highs, because it did outpace on this recovery. Nasdaq is around 4%. Dow from the all-time highs a little bit further. Dow from the all-time highs is around about 6.5%. Russell from the all-time highs, way, way more to catch up. Russell from the all-time highs, about 17%. Does that make the Russell more attractive because it has more room to catch up? I mean, maybe, right? If this is a head and shoulders pattern on the Russell, maybe we get a chance to buy a dip here. Well, there's a good trade. That's a great trade in the Russell if the lows are in. And I do think that with rates cutting, I would hope that Russell can perform well because it gives companies a chance to be more profitable, have a runway for cash. But unfortunately, the Russell's not that profitable. 2,000 companies is not that profitable. Most of them don't make money, which is why I looked at the other ETFs. Like this one is the top 1,000 value plays. This one is the top 200 growth. This one's the top 200 value. They are performing way better, and they're way closer to the all-time highs, right? This one is only off the highs by about 5%, 5.5%. This one's only off the highs by around 4%. Big freaking difference. That's how much more reflexive this is when you eliminate the crappy stocks in this index. That makes sense? So instead of having 2,000 stocks where you got a bunch of dogs and laggards, you have the cream of the crop that's like, yeah, top 200 value does well. Top 200 growth does well. There's growth in the Russell. It's just, it's the haves and the have-nots. So if you buy in the haves, the top 200, that's pretty good. Unfortunately, the option side of this isn't that awesome. So anyway, that's what's going on with, kind of U.S. markets. Non-U.S., I mean, VIX, we're down to some fresh lows again today on the VIX. Bond volatility is down. SVXY continues to kind of ramp up. Unless we have another vol event, I'm just going to, I bought the shares here like 35, let them go at 38. Short-term gain for me on SVXY. Dollar index, I still think the dollar index has room to pull back. Don't force shorts unless you get a trend line to break. Look, this whole thing, if this is a big swing from high to low, okay, I think the dollar in this area, and this area, I know it's not a perfect top, okay, but within this area, I would expect that this high is likely going to be resistant, right? So we have, any bearish pressure is going to come back in somewhere in this region and then hopefully start pushing back down to retest lows. That would be my dollar outlook. Like I'm pretty bearish, at least with the overarching trend, that this move is going to have at least a retest of the low. So if it's a resistance level, resistance area, that it rolls over, gives us a price pattern that we can trade back down to the lows. If it breaks the lows, then you're moving stop losses and you're getting some surplus below the lows. Okay, that's the dollar. Oil, your guess is as good as mine. We broke a floor, but we held the floor. We have just key levels here, right? Key level support. I could see oil just staying in the middle. I think if oil goes higher, that's inflationary. Oil goes down, everyone's unhappy because you can't produce at the same margins. So it's probably just it's going to be a lot of supply and demand manipulation to keep it kind of right around the $60 barrel. And I think everyone can kind of be okay. No major conflicts, no major uproars, no major mutinies. But it's kind of boring. I mean, I'm not bullish or bearish on oil. I just kind of watch and get out the popcorn and see what happens on volatility. I am long natural gas. I'm trading this one out to 2017, so I'm trying to give it plenty of time. But it's also kind of crappy. It's like we had this huge push to the upside, and we might come all the way back down to the lows again. I have no idea. So it's just a trade. I hope I can turn the diagonal spread into profit. I'm selling calls aggressively to lower my debits. Gold. Gold. I've been waiting for a pullback for a while, and I was, sounded like an insane person, just like I don't want to buy gold, and it's going up, and I don't want to buy gold, and it's going up. Well, eventually it peaked out at 3,500, and I'm not saying that it's going to continue to fall, but perhaps it's just an orderly correction. High to low, lower high to lower low, maybe a lower high to lower low, maybe a lower high to lower low, right? This area is a great spot. This area is a great spot. This area is a great spot. Buying gold between 3,000 and 2,800 to me is a bargain. If it's offered, nibble, nibble, nibble. I like gold at those levels. I think that's a good correction level. Okay, it's on this chart, XAU. I have some levels here. So I basically just looking at my daily charts, watching my 200 moving average. I'd love to see the 100, 144, and 200 levels hit. This bar count has gone over 400 bars on a daily time frame, which is pretty excessive. That's literally the same measurements that I took and why I was bearish on the SPY, the Qs, all the indexes this year, because they all had overbought conditions. This is why I was bearish on Netflix and Meta and Palantir and Carvana. And like there were 20, 30 stocks that had the same type of setup where it's like, we'll see a correction. MAG7 was another one. MAGS was also overextended. Okay. All right. 31,900. I mean, it's not, but do I want to buy it at 3,100? I mean, I know we bounced there, but I'm like, look, this is my chart. 100, 144, 200 moving average. That's what I want to see tested. That's what I'm willing to say. Okay. I mean, and I said this yesterday, if you want to buy it here, that's fine. But you talked about dollar cost averaging this morning. If I buy it here, I have to be prepared to buy it here as well. Because if I was going to average into an area, this is fine, because then it's like, okay, I'm participating in gold. If it goes higher, great. Okay. If it doesn't go higher, well, I want to participate more and more and more, and probably make sure it doesn't really break this trend line. So I want to keep dollar cost averaging into this area. If this goes back up to retest highs, hooray, that's my trade. I'm happy. If I want to hold it for, upside forever, fine. But at least making a trade out of this, I need to get a dip or a pullback. Silver, still like silver a lot. 29 is good support. 26 is great support. I don't know if we're coming back to those levels. I would just be watching this right now, this little structure here. So if it just chops around a little bit longer, hopefully something helps push silver higher. If gold is going to continue to decline and correct, I think silver will do the same thing. So, if we see the structure, that's fine. But if this gets a little bit choppier and then goes further to the downside, I'm looking at 29. I'll probably start adding in silver futures trades if we get down to 29, because I can position for that for income. And then I'll probably add shares between 29 and 26 on SLV. Okay, Bitcoin 104. I mean, I'd like to see Bitcoin fall back to like 97. I'd like to see Bitcoin fall back into the 90s, like I should say like 80, 88 roughly, to fill back some of these inefficiencies. But we're sitting here at all-time highs. Clearly, Bitcoin is getting some mainstream love. There is an impressive amount of resiliency, and risk appetite has come back in the markets a big way, and so I think that greed is flowing back into Bitcoin. And technically speaking, if we hit this level, I do think we have a probability that we pull back first to accumulate again before we have another run to all-time highs. Okay, but I'm not letting go of my positions. I mean, if we go to highs on Bitcoin, I'm not closing out my trade at 108. I want Bitcoin to run and get some momentum. Let's get to 120. Let's get to 130. Let's see some headline celebration on Bitcoin. But if we pull back, I'm just going to use it as an opportunity to, allocate and accumulate more. Okay. All right. That 62 is getting called away this week. MicroStrategy up to $400. As long as this one stays above 390 for me, I get like $1,100. I also have, I did the numbers here. So this one's out to the end of the June. I'm still going to roll this one. Honestly, it's like until we see a ton of correction, I'm just going to keep rolling MicroStrategy. So when we get towards the 627 expiration for me, we get towards the 627 expiration, 252.57 minus 310 on 300 shares. I mean, I've got $17,000 on MicroStrategy if I don't do anything right now and price stays above 310. Once we get close to expiration, I can roll my 310 out another week, out another week, out another week, and probably increase this to 18,000, 19,000 over a couple of weeks. Cool. I'll do that. I will use it as income. I'm not trying to chase MicroStrategies to the upside. My call is at 310. So if we stay above this, and let's say this is support and we bounce, I'm not going to chase this thing to the upside. I'm just going to stick with my little 310, keep rolling the covered call, get a little bit of income, and that's all I can do. Now I can participate in separate trades, but I was doing bull call spreads in here. Those are what I'm looking at. I paid $3.50 for something that could pay me $11.50. So I mean, I'm just using it as a high premium. It's highly volatile, but a high premium stock that hopefully can offer me some profit. Pullback levels, I mean, yeah, your pullbacks are fine. If pullbacks, I mean, we pull back here, there's some good structure to offer some support. If we pull back into this run, I mean, you can put a fib on that, right? This is your bigger swing. We go from low to high. There's your big swing. Okay, so take this swing, and where have we been dancing around? Interestingly enough, we've been dancing around this 70% level, right? I'm just going to say this swing from low to high and pulling back 70%, this over my years has yielded a wedge, right? So MicroStrategy might not be the ballistic all-time highs Bitcoin proxy that's 2 to 3 times leverage. It might not be that. If Bitcoin hits 108 and then pulls back to 75, MicroStrategy is probably pulling back to 250-ish, right? Which is okay. It's fine if you're using it for an income vehicle. It's going to be head spinning volatility if it's like it goes up, from 240 to 400, then back down to 250, then back up to 350. It's going to drive traders crazy trying to look for like all-time highs. I mean, maybe my wheelhouse this year is like I've got enough positions now that there's income generation in some of the shares that I own, and that's an easier trade for me than trying to guess where this market's going to go. But that's what I would say. I mean, this to me looks like it could be a potential wedge. All right, Coinbase. That didn't take long. We had a one-day drop from a hack, but because they're being added into the S&P, Coinbase is ripping to the upside. I did some 1-1-1 trades and ratio spreads, which were nice for income. I'm not chasing this at all. So, it's fine. I don't have any trades on Coinbase. Ethereum. I'm sure we got some Ethereum lovers out there. I'm not. I know this ripped very aggressively on the right-hand side of the trend line. A bull flag. I mean, if you're interested, a bull flag here could still get some legs and retest these highs, but you're going to want to see Bitcoin make all-time highs, I think, for Ethereum to catch up. If you started trade one here and you'd use this pocket on this big breakout candle as a second trade, as long as you don't invalidate that low, there's pretty good upside here. I think there's another like 30 to 40% to get to the highs. Yeah, 50, almost 60% to get to the highs. I mean, the trade looks good. I just don't necessarily love Ethereum more than Bitcoin. But I think it's a good trade. Copper, we'll see. These green lines are a little lottery play that I put in. I paid about $90 for something that can make me 1,400, but I need to see copper stay in between here. This trades out for about 40 days. So I'm just kind of calculating, like, maybe this structure is good enough to be so confusing and so choppy that even if it goes down, it kind of swings back up and I can get lucky on a little lottery play. It's, it's a low probability trade. I might win. It's like a maybe 11 to 15% chance I win the trade. But if I do win, it pays, 14 to 1. Japanese yen, If Japanese yen comes back down to here, yeah, I'm going to take some Japanese yen buys again. Nikkei, this is my EWJ exposure. What up, dude? EWJ, this is my way of playing the Nikkei. It drops the bottom 15% of stocks. I'm looking to see if this will revisit all-time highs. If the U.S. market gets to all-time highs, I think the Nikkei will follow suit and go with it. DAX dancing around these all-time highs. I talked about this yesterday in one of my sessions. If we take this low, this high, any type of pullback in here, I would hope has the ability to retest. I think what would be really frustrating is if we go highs, lows, and this is a bear trap or a bull trap, and we come, back down to the halfway point or maybe further down. But that would be the whole U.S. market's going to have to turn south as well. I don't think that's the case. I think if anything, there is a window to consolidate, and then to see if this goes higher. If U.S. market go higher, if U.S. markets go higher, I think the non-U.S. markets go with it. DAX goes with it. FTSE goes with it, right? I mean, FTSE's getting some love. All-time highs are right up here. So if you're long FTSE, probably to these highs, right? And then it consolidates, and then you look to see, can it break and go higher? There's your global asset bubble. Don't fight it, right? If we're going to all-time highs in the DAX and the FTSE and HSI and anything that's non-U.S., I mean, don't fight it. Argentina, all-time highs. Brazil, I think there's plenty of upside here. It's beat up emerging market play, but I like the potential. I like the asymmetry. MAGs are at 52. We'll see what happens here. If MAGs gets a pullback, I would say this: MAGs pulls back in here, then the market's going to come back with it as well. There is some interesting resistance in here. All right, Daniel, take a look at that. Nice. Let's see here. Apple, fine. Amazon, fine. That earnings play, that was disappointing. It was literally a day after. This is a Friday close, and this is Monday. I was so stupid. Anyway, my shares at Amazon, I just have 225 calls, and my break-even price is like 120. So I'm just trying to sell covered calls on Amazon and keep collecting income. Ratio spreads, that's my exposure here. So Amazon ratio spreads. So sitting in some profit here, about 85% of that credit out 35 days, likely going to be a winner, but it looks good enough that are we going to get to 150 by June? 150 is oh boy, there's like a 2% chance that this level's threatened. So yeah, I'm going to hang on to that trade probably till expiration. That was just, down here when prices were down and IV was high, I was selling premium. So I'll look for that income on Amazon. That'll pay out pretty well. I mean, all in all, between this June expiration, that's about $2, $4, $6, $800, and then another $2, $4, $6, $8. Yeah, but about $1,600 on Amazon for income. Shares I own driving the prices lower. Broadcom, I'm not chasing this crap. I took a ratio spread down here, made some money. Google, I'm happy to see that we responded off this 150 low. I put some spreads out on Google. I think the 105 by 100 right now when the premium was really high. So I'm going to ride that out a little bit longer. Meta, turn. I'd like to see Meta come back a little bit. I really wanted Meta to get down to this level. I was hoping we get to like 450 or lower. I wanted to load up some ratio spreads on Meta. Didn't get the opportunity. I took like one stab here. I did some income trades in this yellow box and it worked out fine. Microsoft, just simple dollar cost allocations. I bought in around 400, 415, 400, 375, and it's up in profit. All-time highs are at 469. I would not be shocked to see a bit of a gap fill here at all. We're coming up to some resistance if this pulls back a little bit. So, I mean, one thing we can watch for the markets to turn, if the S&P is going to turn, watch for MAGs. If MAGs turns, then S&P probably goes with it. There's still big stocks that are heavily weighted in the markets. Netflix, another all-time high. Nvidia, had a nice little surge. We got the Nvidia's got a little partnership going on with the with Saudi Arabia, UAE, and looking like they're kind of using them as the big AI build out. So it's nice to see Nvidia kind of come back from the dead. A pullback, I'm sure now it's like buying dips for Nvidia, whereas before it was, I mean, under the 200 moving average, this thing looked like it was dead in the water. Everyone's hating on Nvidia. It's going to lose its competitive advantage. It doesn't actually make chips; it just designs them. So all the haters were, crazy bearish on Nvidia, but it's such a profitable company that I wouldn't be shocked to see it go to the highs again. But I'm not going to guess it's going to $200. Okay. I mean, if it dances around here and then pulls back again, it's like, I'm going to turn my ownership of Nvidia into an income trade. This July collar at 130, once I get close to expiration, I'm just going to roll calls and participate as long as I can until I feel like it's not favorable to roll calls anymore. Tesla, we're trading at 347. I mean, I've got 277.50 covered calls. I have sacrificed, $50 to $60 of upside, $70 of upside, but I also survived all this crazy, high premium with some good ratio spreads, and I'm getting anywhere between like $200 to $300 a week in rolling calls, and I'm going to continue to do that. And if we stall for a little bit, then I can kind of play catch up on those covered calls. Berkshire, nothing there. I do want to check Spotify. I should probably add this into my mix. You piece of crap. I'm trying to see if Spotify will dip back. I need this to stay below 670. I need this to be less than 670 for this June expiration. It's a butterfly, prices up here. I have a profit trap, but I don't want to see this thing going to all-time highs. This high was around 664. My profit trap is 670, but that's right near expiration. So not ideal that this is up here. I'd like to see this kind of fade back down to like 620, 609, whatever. Stay a little bit off these resistance levels. Bond markets, down in the day. I just think that the bond market's going to be just garbage. If we get a pullback in the S&P, then yes, pullback in the S&P might yield a little bit of upticks in TLT. I'm rolling my diagonal spreads down aggressively. So I bought a 65 and I'm selling an 89. And after that 89 expires at the end of the month, I'm rolling it again to an 89 or an 88. Like I'm just going to keep chipping it lower. I'm trying to I'll make a few bucks in this. I'll try to turn this for a couple of hours of income. Initially, the plan was when this thing was surging, I'm like, well, heck, maybe we're going to get this thing up to high 90s. And so I had a 96 call. Well, I rolled that down to 89. So I'm sacrificing some of the gains, but I'm trying to also keep the premiums high if I can. Gold, we talked about it. Gold is, I'm just looking for a pullback towards the moving averages. I like 3,000. I like 2,900, 2,800. I'd like to see some deeper levels pullback wise. Let's see here. That should be about it. Some of the Qs or the China stocks, Alibaba, not getting called away, which is fine. Baidu not getting called away, which is fine. I'll just keep selling calls on those. FXI, I still have some shares. I'm looking at all-time highs. KWeb, I don't have any shares left in this one. JD, I do have some shares. I'm just going to sell some more covered calls. Schwab Dividend, Schwab Growth, bought some shares of those. SCHY, bought some shares of those. Here's your market breadth. 72% of stocks now above the 50-day moving average. 72% of stocks above the 200 or the 50-day moving average. So, this is as far as short-term buy zone. And look, we timed this thing right here, right? When this thing was down to the lows that I've been watching, and we talked about it earlier, we were sitting here early in the year. I'm like, look, if market breadth comes down to these levels, we should be looking at this as a timing indicator to buy. When did that bottom? Well, that low was April 4th. There's April 7th. There's April 8th. We all know what happened on April 9th. Okay. You had an opportunity to get long. I got long on a synthetic long in the S&P, and that was a buy call, sell put at the same strike. And I got a lot of that rip plus debit spreads, plus, selling puts, plus 111s. Like it was a great time indicator, and I like the market breadth indicator for that exact reason. Now, I will say the same thing here. I'm not going to be as aggressively short, but if we have this coming back up to these highs again, when like 91% of stocks are above the 50-day, I'm probably looking at that as a short-term opportunity to take profit, number one, and two, probably get a little bit of a pullback. Okay. Lowest call on gold. I mean, if gold comes back to like 2,800, I'm pretty happy with that. Okay, and this is the 200 moving average. Now we have about 52% of stocks above the 200-day moving average, which means we are getting that buy zone to print again for over half the stocks. I said this week, I mean, this was at like 48, 48, 48, which means that we still had a majority of stocks, slim majority, but majority of stocks are still below the 200-day moving average. But now they're above it. So we have, 70+% of stocks above the 50-day, 52% of stocks above the 200-day. Market breadth is looking a little bit healthier across the board. Sector performance is really interesting this year. If you go year to date, sector performance year to date. So consumer discretionary is still down, which makes sense. I mean, obviously we had some fear in March and April. So, those, if it's like you shouldn't buy it, don't need it, don't buy it. So discretionary down. Healthcare, UNH is probably the big catalyst for this. Look at the holdings. Johnson & Johnson, AbbVie, UNH was a much higher index weight, but because it's been beat up by 60%, it's been dumped. I mean, it's down 45% for the year. That's pretty nuts. But anyway, I mean, industrials, I mean, look, by the way, like financials, industrials, utilities leading the charge this year, this is typically not the bull market that you want to see. If you're aggressively bullish in the US market, you don't want to see industrials and utilities leading the charge. I mean, these are like options are garbage on utilities. They're just basically like high debt dividend stocks. That's what utilities are. Now they're performing well because they're getting deals done with, large cap tech. Like Google is partnering with energy companies. I think Constellation Energy and NEE for Newmont, or what's NEE? Is it NEE? Yeah, next era. So next era, Constellation Energy, they've been really big performers this year. But my point is, like, this is not your typical lead in a bull market. Are others playing catch up? Yeah, maybe. I mean, maybe tech catches up and swings the pendulum the other way because it's back in green territory now. But tech was down, 20+%. So anyway, obviously this year we've experienced a massive rotation. Massive rotation. SPY 595 is growing a little bit today. I don't think enough for me to. It's not going to force me to take a buy trade though. If we get to 595, cool. But I'm not going to trade on. I'm not trading this. What's the expected move today? 89. It'd be a $6 move. What's the expected move on the S&P right now? S&P for the day for the SPY. We got about another $1.76 left, and I'm looking at this thing having to go up like 380. I don't think we're going to get there. So it's tempting, but it's going against the grain of what the markets are probably pricing in right now with this type of volatility. So yeah, I'm not going to take the bait for a 0 DT. All right, I don't realize I've been going for about an hour and 20 minutes, but I'm almost done. So market breadth is coming back. We'll see what happens. Nasdaq, same thing here. 82% of Nasdaq stocks above the 50-day moving average. It's also a pretty good timing indicator. Once we get here where it's like 90+%, it's been a pretty good topping pattern, at least for a pullback. Not saying it's bearish, just a pullback. Okay, other stocks. I mean, Costco's still grinding higher. I've got a bunch of ratio spreads down here in the 600s. Walmart. What's crazy about Walmart is this is, a good barometer for the U.S. consumer. Even the wealthier demographics can still go shop at Walmart if they wanted to save some money. But it's also trading at 37 times earnings, which is very extreme. I think this is probably overvalued, along with a lot of other stocks. I think our PE ratios are pretty high. Not bubbly yet, but pretty close. I mean, we haven't seen valuations this high since 2000. Nike, hold my puts. I've got 55.50 and 47.50 puts. Home Depot and Lowe's are not low enough for me. took some ratio spreads on the cards, MasterCard, Visa, Amex. Not in those anymore. Johnson & Johnson holding some puts. Progressive took some trades. CB is going to be for full profit today. Palantir, not chasing this thing. I just did a ratio spread. This one's already up like 60%, I think. Let me check. Palantir. It is up. So I pulled in 250 on a bunch of accounts. So I don't know. It's going to be roughly $3,000 or $4,000 on Palantir just by. I mean, this is only 34% max credit, so got a lot more to go. But these are all the way down to the 50s. So Palantir's got a long ways to drop if I'm going to have any type of threat to the trade. But you never know. I think Palantir's look as the best performing stock of 2024. The market's clearly given a lot of love this year. This thing's already made a swing of 100%. 100%. Ladies and gentlemen, you could double your account if you just put all your money in Palantir at the 200 moving average. Congratulations. You just crushed the market this year. Kind of, Dennis. Yep, Dennis asked, would you rather wait for them to go down to enter long? Of course, man. I mean, because look, I've been long at the bottoms. I bought the SPY at 496. I bought the Qs. Where did I buy the Qs at? It was just off the lows. I bought the Qs at like 415. So 496 SPY, 415 Qs. It's like, why would I want to buy it here? I don't. So I'm looking at this gap fill. I'm just like, come on, dude, something, anything, and maybe I don't get it, right? Maybe this pullback isn't going to happen. Maybe this pullback it's going to run higher, run hotter, make me mad, and then it hits the highs, right? And then it pulls back. And maybe it doesn't. Maybe it doesn't. Maybe it doesn't. Who remembers 2017? I do. 2017, every single month in the S&P was a higher high. 2017, you can look at the performance month to month in 2017, every month closed green. Yes, we had a disruptive 2025, but if we are about to see a very similar administration, which is fiscal spending plus a Fed that's going to, not rock the boat, okay, then maybe we see every month from May to December positive. Maybe. I don't think that's real because that's never happened in 90 years, but it did happen in 2017. But this market doesn't seem to care right now. So anyway, I'm being a little snarky because it is aggravating to be like so profitable down here and such a, having to play in the fear and have that fear pay you, which is fine. But then when it's up here in like euphoria territory, I'm like, now what? Now I've got to buy highs. I kind of hate that. I hate participating in those highs. So I'm like, just give me something like a test of this gap. It doesn't have to fill the entire gap. Just come back and try to acknowledge that this thing jumped up 3% in 1 minute on Monday at 3 a.m. That's what happened. This movement right here was a 3 a.m. candle on Monday morning. So I'm willing to say that is an inefficiency that usually doesn't happen and certainly doesn't go unnoticed. So I'm hoping we get a bit of a pullback after this cycle with today's expiration and Wednesday's VIX expiration. And then we get something like acknowledge a pullback. Let's get some efficiencies. Let's get some buying opportunities. Okay. All right. Okay. I'll let you go for today. I've been going at it here for a little bit. Should be good for the rest of the day. Yeah. Off we go. All right. Have a great Friday, everybody. Thanks for being with us this week. And we'll see you soon. Thanks. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.